Hi everyone. Next up on our Sustainable Investment series is initiating implementation. In our last Sustainable Investment series, we tackled terminology and spoke in detail about the differences between ESG integration, socially responsible investing, and impact investing. If you haven't yet listened, I encourage you to start there before listening to today's series where we'll discuss implementation. For purposes of today's discussion, we will use the term sustainable investing, which will encompass all three of these investment approaches. Anytime a long-term investment objective is changed or added, it's important to address it in the investment policy statement. So this is where we'll start. For sustainable investing, these are often addressed in a separate document referred to as the Impact Investment Policy Statement, or the iips. Documenting the objective is not only consistent with best practices from a fiduciary perspective, it is also helpful in ensuring that the objective is shared and understood amongst all stakeholders. The process of drafting an iips forces a dialogue that helps better connect different viewpoints on these sustainable issues into a clear and concise objective that can be more easily applied by the underlying investment managers. In structuring an iips, we recommend starting with the organization's mission or the role of the investment portfolio in satisfying key objectives for the organization. This sets the stage and keeps the focus on the underlying organization rather than the personal beliefs of the decision makers. We then recommend introducing the United Nations Sustainable Development Goals, referred to as the SDGs for short. The SDGs have emerged as a universal framework for discussing sustainable investment issues. We're seeing companies include SDGs in their annual reporting, managers reference SDGs in their investment commentary, and investors communicate their sustainable investment preferences in terms of SDGs. Your consultant can then work with you to evaluate the various goals and prioritize focus on the SDGs that are most closely aligned with the objectives of your organization. It's also important to create a benchmark of sorts for the meaning of sustainable investments as a way to measure what it is you're trying to achieve. This can vary and should be flexible enough to allow for some type of implementation across all asset classes and manager types. We will discuss this as well as compliance in a later series. Lastly, if the iips is a separate document, the overarching investment policy statement should be referenced for purposes of evaluating the portfolio, both from a risk and return perspective. As clients begin the implementation process, we also recommend addressing the current portfolio before it can be determined how best to move forward to achieve a sustainable investment objective. It's important to understand the starting point. Oftentimes, clients are surprised to see how managers are currently addressing these issues, especially in terms of ESG integration. More often than not, managers are already incorporating these elements into their risk analysis, even if they're not marketing their fund as an ESG product. There may be different ways to peel back the onion of a portfolio, and your consultant can work with you to determine which approach makes the most sense, depending on the underlying holdings. For example, certain vehicles are less transparent than others, and the overarching objectives. The last element we will discuss today is manager selection. Regardless of the approach to sustainable investing, all managers undergo Marquette's rigorous four-phase approach. The difference being, in addition to this analysis, Marquette's dedicated sustainable investment group, alongside Marquette's dedicated ESG analysts, provide an additional layer of oversight in the selection process. As sustainable investing continues to gain traction in the market, there's a growing concern that managers are simply greenwashing their products in an effort to accumulate assets. To better identify true sustainable investing managers, we've established the following best practices. The first is that we expect the manager to have a clearly defined framework for incorporating their sustainable investing strategy. This may differ in terms of size and scope, but similar to our expectation that clients have an investment policy in place, it's important from an execution and compliance perspective that there is a clear process to follow. When feasible, we like to see at the very least some sort of internal research development, rather than pure reliance on external data. This shows that the manager has invested capital in the process. As the trend within sustainable investing continues to move from a more reactive to a proactive approach, we expect to see greater levels of corporate engagement by managers. Managers that have shown a history of shareholder activism will be better equipped to benefit from this trend and improve shareholder value. Lastly, we like to see some level of reporting, both in terms of the underlying holdings as well as the firm itself. Managers that walk the walk are more likely to better assess these issues at other companies. That concludes today's series. Thank you for listening. We hope this provided you with a better understanding of how best to implement a sustainable investing program.